Next speaker for the day is Mr. Rakesh Pujara. I'll briefly introduce him. Mr. Rakesh Pujara is an ICWA and has been in the market since 1992. He has been part of Shri Naman Securities since last 18 years. He is a veteran market player who has traded all facets of the market. He is a disciplined trader and investor who has algo trading very close to his heart. Please join your hands for us to welcome Mr. Pujara. One more thing, he's like a guru to us. Whenever we go to him with any issues related to algorithmic trading, he has a mysterious way of identifying what's going wrong, where will you go wrong. He can see miles away what we cannot see. I mean, we don't need to really backtest some of the things. Obviously, backtesting does tell us, but his experience is good enough to tell us where we can go wrong. He'll say, boss, tum idhar giroge. And we really realize that, boss, hum idhar hi girte hai. So, with his wisdom and experience in market, I'd really like you to pay attention to Mr. Pujara. Welcome him once again.
Thank you, Devang, for the kind introduction. Good evening, friends. I am Rakesh Pujara. I am in this market since last 25 years. I am CEO at Shri Naman Securities and Finance Private Limited. Although I am involved with several verticals at Naman Securities, algorithm trading, I have been trading in live environment, and that is very close to my heart. It's been only 5 years. The journey has been really fascinating, and I'm more than happy to share some of my experiences during the last 5 years and demystify some of the facts that can help you get started with the algo, and if you're in the middle of the algo, it will help you improve your algorithms. Although today the topic given to me is to demystify algo trading, I'll take the liberty to extend the subject and say I'm going to demystify some of the facts relating to algorithm trading and investments. In the presentation, you will find there are several quotes presented at various junctures. The reason being, I truly believe in these quotes, and I believe that this is a simpler way of giving some powerful ideas. In the middle of presentation, you might be tempted to ask a few questions. I'll be more than happy to answer a couple of them at the post-presentation, and if you have some more, we can definitely talk about it in the networking session. With this, I begin my presentation. So what is an algorithm? Algorithm, by definition, is a step-by-step procedure designed to perform an operation can you please help with the mic, please? Yeah, thanks. Thanks, Devang. By definition, it's a step-by-step procedure designed to perform an operation which will lead to short results if followed correctly. In simple terms, it means to follow a set of predefined rules or processes to achieve desired results. The next slide, what is the scope of an algorithm? Although it is used in stock market, the algorithm has a very, very wide scope. I've enlisted some of the few examples where algorithm has been used. One of the leading NBFC of India lends on the basis of algorithm. They use a number of assumptions, criteria based on research. One being the married man aging between 25 and 35 do not default on consumer loans. And the recovery rate is as high as 99.9%. This kind of a simple fact actually can sort the life of an NBFC, and they can actually blindfoldly lend to the guy who is between 25 and 35 and who is married. So he doesn't have to meet other criteria, and the process becomes much faster. Second data point that I want to give you is, like, historically, I think all of us at some point have invested in real estate and are going to invest in future. So this kind of a data point which I'm going to share can help you in doing that. Indian real estate has delivered higher returns when the inflation rate is above 6% and has delivered a below par return, or in some cases it has delivered a negative return if the inflation rate is, say, below 6%. Algorithm can also be used to predict election outcomes and events like Brexit. There are algorithms doing all that. Algorithm can also be developed on the basis of macroeconomic data like interest rate, inflation, fiscal and monetary policy, etc. In the next slide, I'm going to share one of the algorithms that can be really very, very useful for us. In the slide 4, see we have this chart which shows US interest rate cycle and its correlation with Indian markets. It clearly shows an inverse relationship. It has got an inverse relationship between US interest rate cycle and performance of Indian market. I've highlighted four cycles, and I'll give you the data of that. Like from January 2000 to June 2003, Fed eased rate from 6.5% to 1%. In the same period, Nifty moved negatively by 26.5%. So like Nifty did nothing for 2.5, 3 years, and it moved negatively by 26.5%. From June 2004 to June 2006, that's around 2 years, Fed raised the rates from 1 to 5.25%. In the same period, the Nifty delivered a return of 108% positive returns. 108% in just 2 years. Third cycle, from 2007 September to December 2008, Fed eased the rate from 5.25 to 0.25. In the same period, Nifty delivered a return of negative 41%, 41% negative, and you are out of market. If you are following this, you are out of market for 15 months, and the whole pain is avoided if you are just following the simple data point. Now, from December 2015, again the Fed has started hiking the rates, and the interest rate is now, it has moved from 0.25 to 1%, and the current cycle is still on. And if you believe in this, you guys can remain long till the cycle ends, and make a whole lot of profit out of that. So in this 17-year cycle, if you follow this simple data point, believing that what has happened in the past will happen in the future, for example, then you would be in the market, out of 17 years, you will be in the market only 7.25 years, and you would have made a return of 197%. 197% in a period of 7.25, that is an annualized return of 27%, and mind well, I'm talking an return on an index. Nifty is an index. 27% annualized return on an index is really, really fantastic. And again, Nifty is a leverage instrument. So you can understand the kind of return you would have made if you have done some sensible leverage on that. So I want to highlight one point here. In 2013, Fed started tapering. So that was like unwinding of quantitative easing that started happening in 2013. And all the noise about interest rate hike started happening around December 2015, when Fed actually hiked the rate for the first time. And if you read the articles, if you take the opinion of expert on television and social media and everything where we were like bombarded with an article which was scary, and probably many of us would have squared positions, kind of sell off our long-term portfolio and then be ready for the interest rate hike, you know. And see what happened. Even we were faced with this problem. We started analyzing the cycle, and this is what we found. So the point I'm trying to make, if you remain objective and stick to data, analyze it, and then frame an opinion and then start executing, you are better off rather than getting carried away by the media noise and the noise all of us, including myself, like expert people like us, create, you know. From this, it is very evident that the algorithm has a very, very wide scope. It's not only limited to stock market. However, today we are going to talk about use of algorithms in stock market, trading and investments. Algorithm. Why should we use algorithm? If I put in the words of Jesse Livermore, all through time, people have basically acted and reacted the same way in the market as a result of greed, fear, ignorance, and hope. That is why the numerical formation and patterns reoccur on a constant basis. So there is a reason why a numerical pattern happens on a constant basis, because over a period of time, over generations, the action and reactions of people have almost been identical. So algo trading can be used to identify such setups and patterns, and which with rule-based approach they can be traded profitably. I'll quickly zip through some of the advantages. There are many more advantages. I'll zip through some of them very quickly for the lack of time. Basically, since it is rule-based, it minimizes emotions. It minimizes emotions, but definitely because there are no discretion available to you. Once you are hooked onto an algo, once you have decided to execute it, you have to do as directed. Since it is rule-based, it minimizes. It definitely helps minimizing your emotions. It has the ability to backtest. You have a lot of past data available thanks to data vendors and people like Reliable Software and all. You have a lot of data available. You can backtest. You can see the result. If you don't like the result, you change the parameters or you do whatever you want, and then you find again backtest. Once you're comfortable, you can start running the algo. So the ability to backtest the past data is one of the greatest advantage that an algorithm has. Third one, it preserves discipline and consistency. Again, I'll emphasize that since algorithms are based on rules, it preserves discipline. Everybody of us will agree whenever we have lost money, somewhere down the line, we are not being disciplined. We have broken the rules. We have broken our own rules. We have broken our own beliefs. And that is where we have incurred the loss. So algorithm is kind of a stepney. It helps you to remain disciplined. And it helps you to remain consistent even during adverse times. If you're facing a drawdown or a losing streak, but if it is rule-based, you stick by it and it gives you consistency. And that consistency gives a consistent pool of profit. Not the algorithm itself. The discipline with which you execute and the consistency with which you execute will create a sustainable pool of kind of profits, you know. The fourth one, an important one, it helps you diversify in trading and investment. See, with algorithm trading, see, in today's environment, with technological development, most of the algorithms are kind of automated. They can be traded with high-speed computers and connections and co-location servers and all. So that has increased kind of your bandwidth to trade various instruments, to trade various asset class, and it helps you diversify. And the more you diversify, you reduce the risk. That is important. The more diversification, the more the risk gets reduced, and you are able to survive for a longer period of time. There are many pitfalls, but I'll take 2 or 3 very quickly. One of them is, of course, mechanical failures, like you have, if your lease line down, if your internet down, and your computer is down, all this can happen while trading, and it can actually reduce your mathematical expectancy of the strategy because of some mechanical failures, late execution or skip execution or whatever. The next one is need for continuous monitoring. It's not that you switch on the computer, run the algo and go for a garden walk, come back in the evening and see like how much profit I have made. It's not that simple. It needs monitoring. It needs monitoring live environment. So whatever algo you have created, whether it is executing the way you have envisaged it will execute, or it is differing, or there's some bug inside, or there's some mechanical failures, all this needs to be monitored. The third and the most important pitfalls, which is over-optimization. Over-optimization refers to excessive curve fitting that produces a trading plan that is unreliable in live trading. Be extremely wary about this. Traders who employed backtesting techniques can create systems that look great on paper and perform miserably in a live market. Algo basically comprises of 2 aspects. One is quantitative, other one is qualitative. I have broadly defined this. The quantitative part covers creation of an algo, using data, analyze it, drawing conclusions, and making profitable trading strategies and efficiently executing them with various tools. The qualitative part covers psychological and behavioral aspects, to my mind that is more important, of trading and investment. How do you react when you are facing a drawdown? How do you react when you are facing a losing streak of trades? Continuously you are losing. Do you change from one strategy to another? You stop it, you double it? These are the real questions that will happen when you start trading live algos, and these are the questions that real focus attention. I think too much emphasis is put on quantitative part of algorithm looking for holy grails. Enormous amount of time and money is wasted looking for a system that works all the time, buying some expensive software, going to some expensive seminar. Too much time is wasted on that. People, today, in today's environment, people have actually gone berserk over fast execution, like my algo executes within seconds, somebody's nanoseconds, and somebody's milliseconds and all that. This is what is happening all around. Mind well, the quantitative part can be taught. It can be learned. The qualitative part has to be cultivated. It has to be cultivated through your own experience and with the experience of others. Even within the quantitative part, if you decide to pay attention, you have to pay attention, more time and effort on the creation of algorithms that suits your temperament, personality, and risk profile. Faster execution tools are available and newer ones are coming every day. So you should not be overly worried about that. Today, within the quantitative part, I'm going to talk more on the parameters that should be considered while evaluating the algorithm and its robustness. Creation of an algorithm is very personality-centric, and various books, articles, videos are easily available and should be used for creation of your own strategies. We have organizations like Dravyaniti, Reliable Software, and other people around who can help you with the creation of an algorithm. So let us look at the parameters that you should look when you are actually, so if somebody presents you with an algorithm and you are evaluating whether the algorithm is good or not, whether it is robust enough or not. These are the 8 parameters which I think are important. Of course, there are more that should be considered before actually putting the algo live. The first one is compounded annual growth return. Compounded annual growth return is average annualized return, as all of us know, over the period you are looking at. And in the emerging market like India, anything between 20 to 35% CAGR is good enough. Mind well, the number is an average number, and sometimes it can be a misleading number. Suppose I have to calculate, suppose there is an algorithm which gives a simple return of say 20%, but the distribution of this 20% can be really, really different. The first year can be minus 20, second year can be plus 20, and the third year can be plus 60. So if you totally, your average is like around 20%, it looks great, 20% return, kind of a tax-free return you get, it looks great, but when you actually live through these 3 years, at the end of the second year, you might end up giving up, saying that, no, this is giving me nothing. First year, it gives me minus 20, second year, it only covered it up. And the third year, when you actually give up, 60% return comes. Second one is maximum drawdown. Maximum drawdown measures the maximum depth of an equity peak to the equity trough. For example, if you start with an equity of 100, and if your equity drops to 90, so you're facing basically a 10% drawdown, which is nothing but an under equity because you started with 100, it is 90, so it's underwater equity. After doing this, suppose you decide to continue with the strategy. Then I'll continue with the strategy, I have a belief in the strategy. The equity goes to 150, and then it gives up 30 points, come back to 120. Basically, this 30 points that has come up from 150 to 120 is nothing but the drawdown. And if it happens to be the maximum during the sample back test, it is referred to as the maximum drawdown. The next one is CAGR upon maximum drawdown. Perhaps the easiest risk-adjusted performance measure for layman is dividing compounded annual growth rate by the maximum drawdown. This ratio is more robust guide to risk-adjusted return. The higher the ratio, the better. And a reading over 0.75 is good. Anything above 1 is excellent. So that number should be kept in mind. Risk per trade and position sizing. This is a very, very important thing. How much risk you should take per trade? That is a question that all of us have at some point in time. Worldwide, people are following a 2% rule per trade kind of situation, but for us, 2% per trade is a too high a risk to take. One of the reason I tell you is like when you follow a 30% winning rate strategy, for example, you have a probability of having 30 trades as a loss trades on the trot, one after another. If you're following 30% winning percentage, you can have 30 trades as a loss trade statistically. So if you have 30 trades and if you lose 2% of equity on each trade, basically you are wiped off 60%. And most of us, we do not have this kind of an appetite. So for us, anything between 0.2 to 0.75 is good enough, a risk to take. The next one is winning percentage and win-loss ratio. Winning percentage is derived by dividing number of winners by the total number of trades. The win-loss ratio, also known as a PF ratio, is calculated by dividing the average win by the average loss. Over the years, what we have come to understand as algo trader, we have two choices. First one, accept a high win-loss ratio at the expense of higher winning percentage. Or pursue a high winning percentage at the expense of high win ratio. Although it is logical to desire both, they rarely coexist. At least not with the robustness of system that I know. They will consistently do so in future with the same amount of consistency, kind of. If you see a high winning percentage coupled with a high win-loss ratio, then you should be very, very suspicious about it. Such system generally doesn't exist. The next is commission and slippages. Commission and slippages play a very, very vital role in deciding the final mathematical expectancy of your strategy, how much return annually you will arrive. Particularly in a market like India, where liquidity is not all that great, you're executing order at some very, very abnormal prices because there is no depth around. And the only way you can minimize your slippages and commission is to stretch your time frame, or what you can do is you can put in more, you have to actually reduce your number of trades. If you reduce your number of trades, you'll be able to actually reduce commission and slippages. One of the ways you can reduce trades is to stretch the time frame. If you stretch your time frame, number of trade, one of the ways is to stretch the time. Another way could be you put in more conditions in the algo, and then you do the trade, it will reduce number of trades. And if you put more conditions, you might sacrifice a bit on the return, but the commission slippage will be very, very minimal. The next one, very important for us, is time frame. See, although there are various choices, from going tick by tick to maybe nanosecond to maybe 5 minutes to 15 minutes, maybe to 30 minutes, to be daily, it could be weekly or monthly. See, higher the time frame, the better for us, particularly in India, where, as I explained to you earlier, commissions and slippages and transaction costs and STT, and it's like they're way too high for any of us to pursue HFTs and very, very high frequency trades because of the cost involved doing that. Apart from co-location server cost and lease line cost, and you have to have a very, very large amount of slippage and STT and government taxes. So for us, higher the time frame, the better. Last but not the least, leverage. All of us know here, leverage is a double-edged sword. If you use it judiciously, it can actually increase your return dramatically. But if you are over-enthusiastic about use of leverage, it can wipe you off your trade, it can wipe you off your business very, very quickly. To know the process of creating an algo and how to trade in the live environment. So before I go to my next presentation, what I've done is I've designed a system which has got a win-loss ratio of 6, which has got a winning percentage of 80, upwards of 80 rather. It has got a drawdown of less than 5%, and it has got a compounded annual return of 30%. Although it is not scheduled to be included here. And one important thing, it has never given a negative return since last 17 years. So since it is not scheduled, may I ask your permission, how many people are interested in this kind of system? I can spare 5 minutes here. So I see a very, very large number of people wanting this kind of system. So can we have this system on the, what it says, If it were that simple, everyone would be rich. Basically, I'm not trying to make fun out of you, but I'm trying to emphasize. If somebody shows you this kind of system, show him the door. Don't even look at such system. They don't exist. At least to my knowledge, they don't exist. This 45-degree kind of an equity curve, they look great on paper. They are repainted. They're kind of there to mislead you. They don't exist. I'm not here to scare you, but I want to share some of the realities of algo trading when you're trading in a live environment that should be helpful before actually you live algos, you know. The first one, this table basically, before I go to the table, I would like to say what Ed Seykota says. Ed Seykota says losing a position is aggravating, whereas losing your nerve is devastating. You should not lose your nerve, right? You can lose a position, but your nerve has to be all right. This table says if you do 50,000 trades, and if you have a winning percentage of 30, then you can have a probability of continuous losing trades of 30. If you're on 35, then you have a losing streak of 25, so on and so forth. So looking at this level, like now you're mentally prepared. Okay, I have a system of 30% winning, and I can take 30 loss. My risk management system is very, very robust. I can take care of it. So on and so forth. That is what you will decide. And then go to the live trading. See what happens. Though it had a statistical probability of 30 losing trade, I have done it myself, when we traded this strategy with 30%, we have faced a losing streak of 44 trades. 44 trades, one after another, were a losing trade, and again the sample size was only 2,500 trades. So statistically, yes, it was like out of 50,000 trade, you can have 30 trades as losing streak, but when I did it live for 2 years, this is what happened. 2,500 trades, and I lost on 44 trades on the trot. This will happen. I'm telling you, it's going to happen. It will keep on happening. That is why too much emphasis has to be paid on the risk management system. You should be in the market to survive this kind of an adverse situation. The next slide. So what is the reality of drawdowns? See, many of us are not even prepared for drawdowns, but that's going to be drawdowns. You can't be having 45-degree of equity curves. So when we backtested strategy for 6 years of data, it was basically an intraday strategy. So sample size could have been little less, that's fine. 6 years of data showed a maximum drawdown of 14.5%. What happened but? In the next 2 years, when we started running the strategy live, it faced a drawdown of 24.5%. 24.5% is 80% more than what is shown in the backtest. What happens when you face this kind of a drawdown? You go back to the drawing board, you start analyzing, you start questioning yourself, something has changed, market is doing some funny things, and I think everything has changed in the world. So we should look for some better strategies or better way of looking, we should generate some random walk or XYZ, everything happens. Because you're losing money. You're not in the right frame of mind. We go to the drawing board. We also did the same. We went to the drawing board, we evaluated our strategy, but then we found that we have a mathematical age and a positive expectancy after this strategy. Although my strategy was showing 19% CAGR return, now it is showing only 14%. It is showing a drawdown of 24.5%. We decided to stay on the course, and we run it for the next 3 months. What happens? The reality is we recovered from the drawdown in the next 3 odd months. So what we lost in last 2 years, we could cover within 3 months. Just because we stayed put on the course, we believed in the mathematical age of our strategy, and we had enough backtesting. We had done enough round of discussion, everything before putting it live, and then we had put it live. So we decided not to second guess ourselves, and stay put with the strategy. So that is how things will happen. The next one. The next one is, this is even better. This is even better than drawdowns. This chart basically shows, it's a daily chart. Again, it's a Nifty chart. Basically, it shows that if you are above the line, you should be long. If you are below the line, you should be short. It's a simple strategy. This line is nothing but simple exponential moving 150 days moving average. This here, this candle here, this one, is a candle of 8th of November 2016 when the demonetization happened. So basically market ended at 330. And since your strategy says you should be long, if the prices are above the line, you went long onto the market. See what happens. 8 o'clock, suddenly you are having your dinner, and Mr. Prime Minister, Mr. Modi comes on, and he demonetizes. He demonetizes, nothing works now. No 500 points, no 1,000 rupee notes, everything is demonetized. And you start having goosebumps. What do? You have a sleepless night, hardly you could sleep for a couple of hours, wake up early in the morning, and you see the Trump is winning. Oh my God, I'm gone. Trump is winning. What do? I'm long in the market, and probably, now it's end of the world, Trump is winning, so world is coming to an end. So you take an urgent meeting with your team, land up in the office at around 8 o'clock, have a meeting. What do we do, like? We have to navigate through this. It's a very kind of a sad day. We are long in the market, and this is what has happened. Dow Jones is down 1,000 points. Your Nifty is showing 300, 400 points down. This is what is going through your mind. And let's say you decide, okay, let's modify something today because it's an exceptional day, and we shouldn't be sticking to our rules, and which we can, for the time being, we can modify. So we decided, say for example, at 9:15 in the morning, you decide, today we are not going to execute end of the day, otherwise you're going to execute at 3:30. What we'll do is, to reduce our loss, we'll start executing on half an hour. Half an hour is the time frame that I've changed from daily. Because there is an extraordinary situation, my faith is kind of not there now. So see what happens. Suppose you were long on 8th of November. What happened? You still ended up being long on 9th. What you lost was 111 points. If you had stayed long, waited till the day ends, you would have lost 111 points. Now, since you have modified, let's see what happens, what the modified strategy gives you results. The next chart is a half an hour chart. This line is basically the value of EMA 150. See what happens. Market opens with a gap down, and you form the first half an hour candle. And basically you square off your long, and you go short in the market because that is your strategy. Since the prices are below the value, you should go short. So what happens is, after 4 or 5 or 6 candles, again the market reverses. Suddenly the Trump is good for the market. Suddenly Dow Jones doesn't show that 1,000 points, and Nifty is recovering, Hang-Seng is recovering, everything is recovering, and you are short in the market. Now what do? You don't have a choice but to go long. Second, third, fourth, fifth, sixth, seventh, eighth, and ninth, 8th candle, you again go long. So what happened is, how much you lost on this? If I give you statistics, first candle close was 8305. Stop and reverse at this price would have resulted in a loss of 238 points. At 145, on 9th candle, you would have to cover your shorts and go long in the market at around 8420, and that would have resulted in a loss of 115 points. And end of the day, again, you are long, and that your total loss, instead of 111 points, your total loss is 353 points, which is nothing but 4.13%, and it is more than 2.83%. So this is what is going to happen in live environment. You are provided for a slippage of 0.05 or 0.10 or at the most, 0.15. Single trade takes your 3% away. 3-4 such trades in a year can destroy the mathematical expectancy of your strategy. 3 or 4 trades a year can actually reduce your return by half and probably make you leave the algo halfway. So when it comes to trading and investing, we are rarely aware of what hurdles actually lay ahead and how to deal with them psychologically. When faced with an unknown or unexpected disruptions, we tend to deviate from our plan in order to alleviate the uncomfortable feeling. Our emotions, fear, greed, uncertainty, and our need to be right all steps in and hinder the progress. So what do we do? We know this is a reality. What do we do? What do we do about it? So here are a few tips and tricks to help you remain objective. That's the only thing that can help you in this is to remain objective. Be data-centric. Stick to your guns. Believe in what you are doing since so many years. Don't second guess. Don't second guess. The more aware you are of your thought process, the better prepared you can be to overcome negative emotions when they occur. All these 15-20 minutes I spent is just to arrive here. I want to talk more about this than the earlier part. The only thing I wanted to maintain the flow. That is why I've talked on the earlier part. This is what will decide whether you'll be able to stay in the algorithm business for long or not. Not the earlier part. Not the earlier part. The quantitative part, I'm telling you, it can be taught and learned. So I'll take around 15 to 20 minutes to explain this. Sorry. So what its slide says, there are around, I'm going to talk on 1, 2, 3, 4, 5, 6, 7, 6 of them. In the words of Mark Douglas, no man ever reacted to excellence in any one art or profession without having passed through the slow and painful process of study and preparations. So it's not a quick rich kind of situation overnight, you become millionaire trading algo, suddenly you find a code and black box strategy that will make you billionaire. It's not that. What are the factors you should be considering? I'll take them one by one. The first I say there are no holy grails. As even emphasized by our earlier speaker, Mr. Shubham Agarwal, there are no holy grails, right? What Peter Lynch says in this business, if you're good, you are right 6 out of 10 times. You are never going to be right 9 out of 10. To push yourself against the wall and say I'm going to be right 9 out of 10 times, it's like asking a bit too much from you. This is a veteran portfolio manager, Peter Lynch saying. There's no point looking for systems that are consistently right 90 or 100% of the time and work all market environments and time frames. Amateurs want a strategy that is always working, always profitable, and are very quick to jump from one strategy to another strategy, chasing performance. A key element of failure is discarding a long-term strategy, experiencing short-term difficulties. That is a very, very important key element that can actually fail you. Now let's see what Charlie Munger says. Charlie Munger says, nobody wants losses, like none of us are here in the business to make losses, but let's see what Charlie Munger says. Charlie Munger says if your losses are going to make you miserable, and some losses are inevitable, you might be wise to utilize a conservative pattern for investment and saving all your life. So you have to adopt a strategy to suit your own nature and your own talents. I don't think there is one size that fits all investment strategy that I can give you. If this is what is said by Charlie Munger, I think nobody is above him, and we should follow what he is saying. The idea is to design a system, to me, this is my personal opinion, a system that gives you 40% winning rate, and if your win-loss ratio is about 2, I think it should be good enough. You shouldn't be looking for 70, 80, 90% system, because such system, ultimately, then it will have to sacrifice on the risk management and all that. Again, these are no final rules or regulations. To each his own. You can have your own way of looking at things. There is no one size that fits all. So basically, it's a very, very individualistic journey. It's not like a custom made. What does the next slide says? Don't predict the outcomes. Go with the flow, and know that you have an edge. Ray Dalio, one of the veteran hedge fund manager, what he says about it? He says, time is like a river that will take you forward into encounters with reality that will require you to make decisions. You can't stop the movement down this river, and you can't avoid the encounters. You can only approach these encounters in the best way possible. You can't stop the river flow. You have to flow with the river, and you have to live with the encounters that will come through the river. Regardless of what you want, the market is going to do what market is going to do. So just let it be. Focusing on future event that you cannot control will only stop you from acting in the present moment. So we should avoid doing that. What CFAIT says? CFAIT says trading with an edge is what separates the professional from amateurs. So he's emphasizing the importance of a trading edge. An edge is a mathematical outcome of buying and selling process. Specifically, the knowledge that generated profits will outweigh losses. It can't be stressed enough that if you do not understand why profits are generated, then you will find it extremely difficult to stay the journey when hurdles come along. If you have a proven edge, all you need to do is, when the market gets tough, is execute the signals rather than make difficult decisions under stress. If a strategy has a mathematical edge, and it is that edge that creates profitability over the long-term period, not your predictive powers. Just let your strategy and position evolve, everything else will fall in place. So next slide. Next slide is basically a demonstration of how mathematical edge can help you. It's the slide of Mr. Bill Dunn, who is again a very, very veteran kind of a manager, portfolio manager. The slide is from 1974 to December 2010. I'm going to share some of the, this is equity curve, and this is S&P returns. Okay, this is what it is. I'm going to give you some key statistics. If somebody gives you a strategy which is giving 19% CAGR, he's got a CAGR of 19%. How many of you will take it with both hands? How many of you? 19% CAGR, good return, almost tax-free, 37 years, like you've created a castle for yourself. I'm going to share you some of the harsh statistics that go beyond this simple analysis of 19% CAGR. What are the factors? It has got a maximum drawdown of 60%, not 16, 60. 60% drawdown, that means your capital can get wiped off up to 60%, and now I want to see how many people want to go with this. I think nobody is raising hands anymore. So, again, it has got an average major drawdown of 38%. 38%. There are 10 drawdowns that are greater than 25%. And almost importantly, in the very beginning, he faced a drawdown of 52%. If you see his equity curve here, in the initial stage, he faced with a drawdown of 52%. And majority of would have been kind of an underwater equity. Not to suggest that we should go with this kind of a strategy. The point I'm trying to make is his conviction in the mathematical age. He was very convinced that this is the strategy to be followed. So in spite of this adverse drawdown, he stayed put for 37 years, and ultimately he could outperform S&P, which gives 12% return, by 7 percentage points. CAGR of 19% is basically 7% per annum. Outperformance for a period of 37 years, it's a great number. I'm not suggesting we should go for this kind of strategy. The point I'm trying to make you understand is, once you are convinced that your strategy has a mathematical edge and positive expectancy, you have to do all the hard work before that. But once you are live, you should stay with it. You should not change time and again and start doubting yourself every now and then. As of today, if I give the figures, as of today, Mr. Dunn manages several $1 billion under his asset in spite of this kind of erratic drawdowns. The next one, be a good risk manager. Let's see what Ed Sikota says. Ed Sikota says, if you can't take a small loss, sooner or later, you will take the mother of all losses. Mother of all losses is saying, if you can't take a small loss. The element of good trading are cutting losses, and cutting losses. If you can follow these 3 rules, you may have a chance. It's not saying you will have a chance. What it's saying is you may have a chance. So only way to survive is to manage your risk properly. You cannot control the market. What you can control is how large any loss will be. Over the long term, you can skew the number, your mathematical edge in your favor by limiting losses and allowing the profit to run. failing to manage a losing trade adequately will work against your edge. So algorithm should be invariably including robust risk management system which provides for taking small losses and not wait for large kind of a loss. The next one, think long term. Don't think short term. What Seth Klarman says, one of the fundamental investor, the single greatest edge an investor can have is a long-term orientation. It is time, not the timing, that makes you money in the markets. Most people overestimate what they can do in 1 year and underestimate what can do in 10 years. It is said by Bill Gates. Basically, the point I'm trying to make is think long term. You should be extremely lucky to realize significant profits in the initial phase of algo trading. Normally, when you start algo trading, it is always the worst time to do so. Like many of us must have encountered, when you start a new system, it is the worst time. Because that is when you face a drawdown and a losing streak, and in the initial phase, that is the worst time to do so. A lot of people get initial sharp drawdowns and doubt creeps in. And usually this happens because they draw long-term inferences on the basis of short-term trading data. Remember, the game of algorithm and investment, trading and investment is not a 100-meter sprint. It's a marathon. That has to be kept in mind. You have to spend enough time in the market and do enough trades, preferably upwards of hundreds, to create a sustainable pool of profits over a long period of time. Usually it takes 2 to 3 years. This is a very important data point. Usually it takes 2 to 3 years for sound strategy to reach close to 100% probability of turning profitable. So when you run a strategy, it could be as high as 3 years before you see light at the end of tunnel. The first profit can be seen at the end of third year as well. Let your winners run and cut your losses fast. That is what I want to emphasize. George Soros says it is not whether you are right or wrong that is important, but how much money you make when you are right and how much money you lose when you are wrong, that is important. What Phil Fisher says, that which really matters is not to disturb a position that is going to be worth a great deal more later. So basically you have to let your winners run. The large money is made capturing large swings. Therefore you need to allow the trailing stop room to have the large trend can continue. A natural byproduct of this is that on the occasions, large open profits can be given back, creating the urge to take profit quicker next time. Cutting a profit short adversely impact the win-loss ratio and therefore the system's expectancy. Letting your winners run improves win-loss ratio dramatically, and occasionally you will find multi-baggers in the process. The very last one, you have to use algorithms, to my mind, again this is very my personal opinion, people can choose to differ. Use algorithms for wealth creation, not to win your daily bread. Let's see what Albert Einstein says. He says compound interest is the eighth wonder of the world. He who understands it, earns it, and who doesn't, pays it. Basically, market doesn't have a set pay day like your employer does. Just because you are putting so much effort every day, markets are not obliged to reward you regularly. Rather than focus on wanted outcome, it is best to work through the correct processes that will eventually lead to desired goal. The market will reward you when it is ready. All you need to do is be there to take that reward. Making trading or investment your only source of income will place financial pressure on you and your family. Trading can also be very lonely endeavor. It can create some psychological issues as well. Algo trading or investing is not a quick road to riches. Nothing good ever is. What it will do is build a nest egg over long term, a lot faster than a buy and hold strategy. Don't look at your account balance every now and then. That money belongs to the market, not to you. This kind of psychological mindset will help you navigate to the period of sustained drawdowns and dry spells. This pretty much ends my presentation. Thank you very much and for your time and patience. Remember, if you survive long enough, you will be rich enough.